Hi everyone, so welcome for today's session. Now today's topic I want us to cover capital budgeting, and capital budgeting is one of the major topics in financial management. Actually this topic will lay a backbone of all the other remaining topics. Now the topic is capital budgeting, also known as the investing decision, and this involves capital budgeting decision. This involves commitment of funds in long-term projects which will generate the benefits in future. So therefore it's all about evaluation of long-term projects which are expected to yield the benefit in the future. So now with that, as per the definition, therefore, what are some of the characteristics of the capital budgeting project? When we talk about the capital budgeting project, we are talking about the long-term projects. And these are some of the characteristics of capital budgeting. Number one, they are long-term projects. And since they are long-term projects, number two, they require huge initial capital investment. Number three, the benefits are expected to be realized in the future. Therefore, if they are long-term projects, now before completion or after completion, that's when most of the projects they're expected to generate the cash flows. So that's why you're saying that benefits are expected to be realized in the future. Then number four is that they are irreversible projects. Irreversible project, that means that we're saying that they involve huge capital outlay. So how are those projects irreversible? That means once undertaken, it's difficult to abandon that project. That's what we mean by irreversible project. Once undertaken, it's difficult to abandon that project. Then number five is that they are highly risky projects. What makes this project to be risky? Number one, you say that they are long-term projects. Then the benefits are expected to be realized in the future. If the benefits are expected to be realized in the future, we don't have control about the future. So there is that aspect of uncertainty. So that's what makes this project to be highly risky. And we have various types of capital budgeting projects. Number one, we have what we call the mutually exclusive project. Now, what do we mean by mutually exclusive project? Now, mutually exclusive project, they are what we call substitute project. They are projects which serve the same purpose. That means if one project is undertaken, automatically the other project will be rejected. So because they are serving the same purpose. It's like, for example, having two blue pens, and then you just need one pen, right? Do you take all of them or just take one? Because they are serving the same purpose. Both of them, they are blue. Now that's what you call mutually exclusive project. And you're saying that they are projects which are substitute. That means they are projects serving the same purpose. Therefore, when one project is undertaken, automatically the other one will be rejected. That's what we call the mutually exclusive project. Number two, we have independent project. Independent project, they are projects which does not interfere with each other. So therefore, if one is undertaken, also the other one can be undertaken without influencing each other. Those are what we call independent project. Then we have what we call dependent project. And dependent project are also known as the complementary project. A dependent project, they are projects which depends on other project. That means if one project is undertaken, the other one automatically will have to be undertaken. If, for example, you have project A, project B, project C. In that, project C depends on project A. I mean project C depends on project B. And project B depends on project A. That means you cannot undertake project C if you have not undertaken project B. And you cannot undertake project B if you have not yet undertaken project A. Those are what we call dependent projects. They are projects which depend on each other. That means if one project is undertaken, automatically even the other project will have to be undertaken. Then we have divisible project. Divisible. What do we mean by divisible project? Now, divisible project, these are the projects which can start generating inflow even before they are fully completed. Let me repeat again. Divisible project, they are projects which can generate inflows even before they are fully completed. Now, for example, let's take a scenario of rental houses. Rental houses, you can build like maybe 3 floors. Then you get some tenants. Then after some period, you decide to add other floors. You see, now that's what we call a divisible project. This project has been can start generating inflow even before the whole project has been fully completed. Or also CPA, this course we are taking. Yeah, you know CPA is also a project. I also tell my students that education is an investment. Why? They are long-term project. You don't get certificate in 2 weeks. They require huge initial capital. Now, apart from the school fees you pay, you also invest your time. You also invest your fare, other resources. You know, for the student, what they usually factor in, they only factor in, I paid a school fees maybe of 20,000, 30,000. What about the transport you use? What about the time you invest? So that's part of the capital. Yeah, capital is not about the financial requirement. It's all about the resources and also the time. Then the benefits are expected to be realized in the future. Why do you have to invest in education now? Because in the future you expect to get a job. So therefore, the benefits are expected to be realized in the future. You don't earn when you are studying. The only person who earns is the teacher here. Then number 4, they are irreversible projects. Though in this case most of the students tend to give up, mostly the CPA. Then they are highly risky projects. There is no guarantee that you have to pass. Sometimes you can struggle with the CPA. So therefore, CPA or education, we are saying that it's an investment. Now CPA, a student with CPA part 1 or the foundation level, or student with CPA part 2 or intermediate level, they are eligible to work as an accountant. And most of the evening student, or most of the student, or most of the accountant or the account assistants, most of them have not completed up to the advanced level section 6, but they are working in accounting department. You see, why are they working in accounting department? Because of that certificate they have either for part 1 or the foundation, or part 2, that's for the intermediate level. But you see now, that project has already now started generating some income. That's what we call a divisible project, a project which can generate inflow even before they are fully completed. Then number 5, we have indivisible project. Indivisible project, they are projects which cannot generate income until or unless they are fully completed. You have to complete this project. For example, we can say, what about law or medicine? These are other courses. They are also projects. Number 1, you cannot practice as a lawyer if you are not a member of LSK. And for you to be a member of LSK, you have completed that degree. Yeah. The same with medicine. Even for the intern, they just follow. That's not an employment. They just follow what other doctors are doing until you get the practicing certificate. So therefore, that's what we call an indivisible project. A project that cannot generate inflow unless they are fully completed. Then we have replacement project, and then we have acquisition project. Those are various type of capital budgeting project. Now, how do we evaluate those projects? Yeah, because you as a financial manager, this is the work of the financial manager. For the financial manager, sometimes they usually do assess the viability of a project. And that's what we call now the project evaluation techniques. And project evaluation techniques, this involves cost-benefit analysis in order to determine whether the projects are viable. Viable, that means that will the project be profitable? And in this case, there are 2 techniques which are used. One is known as the non-discounting techniques or traditional techniques. And then number 2, we have discounting techniques. So what's the difference between the 2? Non-discounting techniques, they are techniques which does not take into account the time value of money. There's no discounting of cash flow. Make sure before you go through this topic, you have gone through the other topic of time value of money. That's when you are explaining what we mean by the time value of money. Yeah. Non-discounting, we are saying that it does not take into account the time value of money. But for discounting techniques, there are techniques which take the time value of money. And when evaluating this project, we'll be using discounting techniques. But first of all, let's start with the non-discounting techniques. Saying that there are techniques which do not take into account the time value of money. And they include, number 1, we have the payback period. Number 2, we have the accounting rate of return. Let's start with the payback period. Payback period. What do we mean by payback period? Now, payback period is the length of time taken to recover your initial capital. How long does it take? For example, if you invest 1 million in a project, how long will it take for you to recover back that 1 million? That's what we call the payback period. And usually pay that. For payback period, the shorter the payback period, the better and less risky the project is. The shorter the payback period, the better and less risky the project is, and vice versa. And how do you determine the payback period? So I want us to do an illustration. In our notes, we have an illustration there. So let's go to our notes. And the payback period, there is illustration 1 I have provided there. And make sure, as you watch these videos, make sure you have the past papers with you, and then you also have the notes with you. Yeah, don't just use the videos alone. Use the video as well as you have the notes. Now, illustration 1 under payback period. Illustration 1 on payback period. Consider a 5-year project whose initial investment is 100,000 and the project is expected to generate the following cash flows. So the capital is 100,000. So you're given year 1 to year 5, then you're given the cash flows required. Calculate the payback period of the project. Calculate the payback period. So here you have the period. So this is illustration 1. We have period, the project is for 5 years, year 1, year 2, year 3, year 4, year 5. Then you're given the expected cash flows. Year 1, we expect to generate 35. Year 2, we have is 30. We have 35. We have 25. We have 20. That's what you're given. Then we had invested 100,000. So we want to determine the payback period. To get the payback period, you get the accumulated cash flows. You accumulate the cash flow. So the first one is 35,000. 35 plus 30, you get 65,000. 65,000, you add 35, you get 100,000. 100, you add 25, you get 125,000. 125, you add 20, you get 145,000. Then you want to determine the payback period. You had invested 100,000. So, and here we have our 100,000. So that means the payback period will be 3 years. You recover back your initial investment within 3 years. So we also want, let's also do another illustration. Illustration 2. Now, assuming the above cash flows, now assuming the same cash flow, but now with the initial capital of 120. But now assuming this case, you see in this question, the initial investment was 100,000. Now, assuming the cash flows now was 120,000. How do we get the payback period? Assuming it's 120. So, do I have to copy this? Okay, let me just copy it again. Cash flows. So here we have 35. We have 30. We also have another 35. 25, 20. 35. 65, 100, 125, 145. So now assuming the initial capital of 120. So 120, that's where 120 is. So that means the payback period will be between year 3 and year 4. So therefore our payback period will be 3 years and some months. So how do you determine that specific month? To determine the specific months, you will take the initial capital, you raise the lower limit, you divide by the upper limit minus lower limit, then you multiply by 12. 12 represents the number of months. So you take the initial capital minus the lower limit. Now, for example, in this case, now let's look at this. You see the initial capital is in between 100 and 125. 100 becomes our lower limit, 125 becomes our upper limit. So now let's evaluate that. So the payback period, it's 3 years. Now we want to determine those specific months. You will take the initial capital, which is 120,000, you minus lower limit. The lower limit is 100,000. Then you divide by, You take the upper limit in this case is 125, minus the lower limit. The lower limit is 100,000. Then you multiply by 12. In that case, you get it's 3 years. And that's 20 over 25. Then you multiply by 12. And you get 10 months. If the capital is 120,000, that means the payback period will be 3 years and 10 months. Good. So in your notes, I have provided the advantages and disadvantages of using the payback period. Then another method under the non-discounting techniques we have is the accounting rate of return. Yeah, ARR. And what do we mean by the accounting rate of return? Now, this method uses the accounting profit, not the cash flows. It uses the accounting profit to evaluate the project, and is computed as follows. It's computed as follows. So how do we compute the accounting rate of return? They're saying that accounting rate of return uses the accounting profit. So you take the average accounting profit, that's the earnings after tax. Then you divide by the average investment. Average investment, then you multiply by 100%. And how do we get the average investment? To determine the average investment, you'll take the initial investment, that's the capital. Then you add the salvage or the scrapped value. Now the salvage value is what you realize the scrap value at the end of the economic life, and then you divide by 2. So now let's do that illustration in our notes. The illustration in our notes. Consider a 4-year project whose initial investment is 150,000 with a salvage value of 50,000. The project is expected to generate the following accounting profit. So you're given year 1 to year 4, and then you're given the earnings after tax. So now let's determine that. You determine the accounting rate of return. So to get the accounting rate of return, first of all, you need to get the average accounting profit, average earnings after tax. So you're given the cash flow for the 4 years. So we have 40,000, year 2, 30,000, year 3, 20,000, year 4, 10,000. Then you get the average by dividing by 4, and you get an amount of 25,000. Also, you need to determine the average investment. For the average investment, you say that you take the initial investment of which you invested 150,000, then you add the salvage value, and you are given a salvage value an amount of 50, that's 200, then you divide by 2 to get an amount of 100,000. So now that with that, now let's get the accounting rate of return. Accounting rate of return, average profit is 25,000, average investment is 100,000, then you multiply by 100%. That means the accounting rate of return will be 25%. 25%. Good. So I've also provided the advantages and disadvantages of the accounting rate of return. So that's all about the non-discounting techniques. So now we want us to look at the other part. We say that project evaluation techniques, they are classified into 2. We have the non-discounting techniques of the traditional methods, and then we have the discounting techniques. So let's look at now discounting techniques. Now, and we say that discounting techniques, they are techniques which takes into account the time value of money. So it's all about discounting the cash flow. And they include Then we're saying that their method which takes into account the time value of money, and they include which are those are some of the discounting techniques we can use. Number one, we have the discounted payback period. Number two, you can also use what we call the modified internal rate of return. Number three, net present value, NPV. Number four, we have the profitability index. And then number five, we have what we call the internal rate of return. IRR. Yeah, those are the some of the discounting techniques which can be used to evaluate the project. And these are the common techniques which are used. Now you might be asked, what are the some of the characteristics of ideal investment appraisal method? So what are the some of the characteristics or the features of an ideal investment evaluation techniques? So in short, it's asking, actually those are the best method. You can use the discounting techniques, not the other non-discounting techniques. So one of the characteristics of this method, of the ideal investment project appraisal method, is that it should be a discounting technique. That means one of the characteristics, they should take into account time value of money. Another characteristic is that they should use cash flows instead of accounting profit. Why? There's a difference between cash flows and accounting profit. Now in cash flow, you cannot manipulate the cash flow, but accounting profit you can manipulate. So these techniques should be should use the cash flow rather than the accounting profit. Another characteristic is that it should help in making or it should give a clear decision on whether to accept or reject a project. You'll come to see that. Also, it should also help in ranking the project based on the order of their priority, ranking the project. Most of that one you can use NPV or the profitability index, and then it should use all the cash flows. We have some method which use selective cash flow. So for this, it should use all the cash flows. So let's start with the first one, which is the discounted payback period. I've already said what we mean by payback period. Is the length of time taken to recover the initial investment. We see that the shorter the payback period, the better and less risky the project is. So now I want us to do illustration one. Illustration one in our notes. Consider a 5-year project. Actually the same question we had done earlier, but in this case now we want to take into consideration the time value of money. Consider a 5-year project with initial investment of 100,000, and the project is expected to generate the following cash flow. So you're given the cash flow for the 5 years. Assuming the cost of capital is 10%, determine the discounted payback period. Assuming the cost of capital is 10%, determine the discounted payback period. So you have the period. The period project was for 5 years, year 1, year 2, 3, 4, 5. Then we had the cash flows. Year 1 we have it's 35. We had 30, 35, 25, and then we had 20. Then before now we accumulate, first of all you have to discount. Present value interest factor. This one is not an annuity. As you can see, the cash flow are not the same. They are different. So if they are different, that one you don't use an annuity. So you use the first table. The cost of capital is 10% in year end. So now let's go to our discounting table. Use our discounting table. Use the first table. The first table, 10% for year 1. 10% for year 1, 0.1991. 0.8264. Year 3, 0.7513. 0.6830. 0.6209. Now we can be able to get the present value. You take the cash flow, you multiply by the discounting factor. That 5,000 you multiply by 0.9091, so you get an amount of 31. 818.5, 24,792, 26,295.5, 17,075, 12,418. Now once you get the present value, now you can accumulate. You get the accumulated present value. So this one will be that one 818.5. Then you add 24,792, get an amount of 56,610.5. Then you add 26,295.5, you get an amount of 82,906. You add 17,075, you get an amount of 99,981. And then here you have 11,2399. Now how much had we invested? This project we had invested 100,000. We had invested 100,000. So we want to determine the payback period. Where do we have 100,000? So 100,000 falls in between these. So that's why we have 100,000. Therefore, payback period, it is between year 4 to year 5. So therefore it will be 4 years. 4 years. How many months? So we say that to get the months, you take the initial capital, which is 100,000. You raise the lower limit. The lower limit in this case is 99,981. You divide by upper limit minus lower limit. Upper limit minus lower limit, this is the difference. Or you can just do this. 11,2399 minus the lower limit, which is 99,981. Then to get in terms of months, you multiply by 12. So it will be 4 years. And how many months? Yeah, actually you're getting approximately 4 years, 0.00 months. So it will still be 4 years. Yeah. You see it's 981. It's only 19 shillings for you to get to 100. So that's why it will be exactly 4 years. So you can go and try this question. November 2018, question 2B. November 2018, question 2B. So in that case, you are given 2 projects. Yeah, November 2018, question 2B. So in that question, you have 2 projects. So you evaluate that using the discounting payback period, and then you determine which is the most optimal project. So in this case, we have to. In that case, we have 2 projects. You take the one with the shorter payback period. Good. So that's the discounted payback period. Let's look at something else. Can look at something else. Number 2. That's the modified internal rate of return. Modified internal rate of return. Now, under modified internal rate of return, so don't confuse internal rate of return and modified internal rate of return. Now, under modified internal rate of return, this is the required rate of return, whereby the cash flow generated can be reinvested to earn more returns. That's what it assumes, that the cash flow generated can be reinvested to earn more return. Now, for example, using this scenario, this question we have done here. In the first year, this project is generating 35. Now, what happens? This 35, instead of taking it back to the bank, you reinvest it back for the remaining 4 years so that you can generate further returns. What you generate in year 230, reinvest it back for the remaining 3 years to earn more returns. Now that's what gives now rise to modified internal rate of return. It's the required rate of return whereby the cash flow generated can be reinvested to earn more returns. And how do we determine the modified internal rate of return? To determine the modified internal rate of return, you take the future value of cash flows, not the present value but the future value, then you divide by the initial investment. initial investment, nth root minus 1. Nth root minus 1. That's how we determine that. And remember I said I showed you how to get the future value, the other class, that the future value we have in case of a single amount, it's 1 plus r raised to power n. And how do we get the future value in case of an annuity? In case of an annuity, we said it's 1 plus r raised to power n minus 1 divided by r. That's the formula for getting the future value. And what are the decision criteria? Decision criteria is that if the modified internal rate of return, if modified internal rate of return is greater than the cost of capital, accept the project. But if the modified internal rate of return is less than the cost of capital, you reject the project. But in case the modified internal rate of return is equal to cost of capital, that's what we call point of indifference. Point of indifference. You can either accept, you can either reject the project. So let's do that illustration in our, okay, open with me, May 2019, question 5D. May 2019. May 2019, question 5D. Question 5D, you are told that BD Enterprise is a small medium enterprise in floriculture industry. The company intends to invest 300,000 in a project that has a useful life for 4 years. Has a useful life for 4 years. We intend to invest 300,000. The following are the expected cash flows. So you have year 1 to year 4. You have the cash flows from year 1 to year 4. The company required rate of return is 14%. Now that required rate of return is the same as the cost of capital. Required the modified internal rate of return of the project, MIRR. So you have the period. The project is for 4 years, year 1, year 2, year 3, year 4. We have the expected cash flows, and for the cash flows, we have it's 140. Year 2, we expect 120. Year 3, we expect 80. Year 4, we expect 60. Then how do we get the modified internal rate of return? You need to get the future value of the cash flow. Now, this being the cash flows, we determine the future value. And how do we get the future value of the cash flows? So to get the future value, interest factor, the required rate of return is 14% period N. So the cash flow are not the same. If the cash flow are not the same, we are using the single amount, 1 plus r raised to power n. So it will be 1 plus, okay, the future value, you don't have, the table you have, the discounting table you have is the present value. That's not for the future value. You are not, you will not be provided with the future value. Future value, you have to use the formula, 1 plus r, our r is 14%, 0.14, which is the same as 1.14, 1.14, 1.14. Raised to power, now listen here. This is not 1, this is not 2, this is not 3, this is not 4. We are saying that the cash flow generated can be reinvested. You always start from the bottom, so you use the bottom up. 0, 1, 2, 3. What does it mean? That means if this 140 will be generated at the end of year 1, can be reinvested for the remaining 3 years. The remaining 3 years. That's year 2, year 3, year 4. That's why you have 3. What will generate in year 2, at the end of year 2, can be invested for the remaining 2 years. Year 3, year 4. That's why you have 2. What will generate at the end of year 3, the project is for 4 years. At the end of year 3, will only be invested for the remaining, the 4th year, 1 year. 1. What you generate in year 4, that's the end of the economic period. You cannot reinvest it. That's why it's a 0. Good. That's the logic behind that. So we are determining the future value. This one will mean to be 1. This is 1.14. Here we have it 1.2996. Here we have it 1.4815. Therefore, let's get the future value. You take the cash flow, you multiply by the future value factor. Here you have an amount of 207, 416, 155, 952, 91, 200. This one remains to be 60. And the total future value will be an amount of 514, 568. So therefore, let's get the modified internal rate of return. So that you take the future value of cash flows, you divide by the initial capital or the initial investment, nth root minus 1. Future value we have it 514, 568. Initial capital, we have invested 300,000. The project is for 4 years, minus 1. Now listen here, how do you get the 4th root? Now I want us to do this one as a team. Let's do as a team. You take 514, 568, you divide by 300,000 equals. Once you get the answer, how do you get the 4th root? This is not raised to power 4, it's the 4th root. How do you get the 4th root? This is how you get the 4th root. Press 4. Once you press 4, press shift. Then that icon of raised to power. That icon of raised to power. You see the icon of raised to power? Hapo juu yake imeandikwa. You see this X? That means nth root. So let me repeat again. You have said you press 4, shift, then that icon of raised to power, then press answer. It's of the answer, not equals, answer, then equals. Then you can minus 1. And you'll get an amount of 14.4%. Let me repeat again. How do you get 6th root of 90? How do you get 6th root of 90? Let's do as a team. Press 6, shift, raise to power, then of 90, press 90, equals, of which you get 2.116. Determine the 5th root of 50. Determine the 5th root of 50. You press 5, shift, raise to power, 50 equals, and you get 2.186. Or alternatively, the 5th root of 50, you can also do it like this. 50 raised to power 1/5. Let's do that one. It's the same, eh? This one is, you can also do 50 raised to power 1/5. So can you press 50? Raised to power, open the bracket, you do 1 divided by 5. 1 divided by 5, close the bracket, equals. And you still get the same answer, 2.186. What about the 6th root of 90 is the same as taking 90 raised to power 1/6. So you press 90, raised to power, then you open the bracket. 1 divided by 6, close the bracket, equals. You'll still get the same answer. Good. So now this project has a modified internal rate of return of 14.4. Now should we accept or should we reject? The required rate of return was 14%. Modified internal rate of return is 14.4. That means our modified internal rate of return is greater than the cost of capital. 14.4 is greater than 14%. Therefore, the project we should accept. The project is viable. Accept the project. That's how you make the decision. So that was the second method, the modified internal rate of return. The other discounting technique, which is the most and widely applied technique, number 3, it's known as net present value, NPV. Net present value. Now, what is net present value? Do you know what we call profit? How do you get the profit? Inflow minus the outflow. Now, NPV is the same as profit, and this is how we get NPV. NPV is the difference between the present value of cash inflow minus the present value of cash outflow. Inflow minus outflow, but in this case we have discounted. That's why you're getting the present value of cash inflow minus the present value of cash outflow. And what are some of the decision criteria? Decision criteria when using NPV. If NPV is positive, that means NPV is positive. If NPV is positive, that means it's greater than 0, you can accept the project. If NPV is negative, that means the outflow are more than the inflow, reject the project. But if the net present value is 0, exactly 0, that means the inflow and the outflow are the same. That's what we call the point of indifference. Yeah, you can either accept, you can either reject, depending on the objective of the organization. So I want us to do an illustration. In our notes, there is that question for December 2007, question 1B. Deck 207, question 1B. Deck 207, question 1B. The question is already in your notes. And you're told that Mapeni Limited is considering which of the following mutually exclusive project to invest in. Remember, I said that mutually exclusive project, they are projects serving the same purpose. So therefore, if you undertake one, you reject the other one. So therefore, if they are mutually exclusive, you just need to select one. Each project will generate cash flow over the 3-year period. So you have project M and N. The costs are the same, 10 million, 10 million. Then you have year 1 to year 3. Let me just indicate the question here. $10 million, 10 million. Then we have cash flows, year 1, year 2, year 3. $5 million, 5 million, 5 million, 0, 0, but we generate a lump sum amount of 17.28 million. Then we are told that the cost of capital for each project is 10%. Ignore taxation. The cost of capital is 10%. Required. Determine which of the project to undertake using, number 1, NPV, number 2, internal rate of return, IRR. So let's start with NPV. So we have to use NPV. We start with project M. And how do we get NPV? Is the present value of cash inflow minus present value of cash outflow. To get the present value of cash inflow, project M, you are given the expected cash flow, 555. Now that's what we call an annuity. The same cash flow over a given period of time. Therefore, being an annuity, you will take 5 million with a discount, present value interest factor of an annuity. The cost of capital we are given is 10%, and it will be for 3 years. We are generating 5 million in each year for the next 3 years. So therefore, it will be 5. Now let's use the annuity table. We go to the annuity table. 10% for 3 years, 10% for 3 years. And you'll get an amount of 2.4869. 2.4869. So here you have an amount of 12.4345. So that's the present value of cash inflow. Then to get NPV, you raise present value of cash outflow. How much had we invested? The cost of project M was 10. So our NPV will be 2.4345. That's how we get NPV. We have project N. We do the same for project N. Now, project N, as you can see, the cash flow characteristic. Year 1 is generating nothing, year 2 is generating nothing, then we generate a lump sum in year 3. So that one is not an annuity. So, to get the present value of cash inflow, in year 3 it will be generating an amount of 17.28, then we will discount. Present value interest factor. This one is not an annuity because we are only going to generate that amount at the end of the third year. So, it's the present value interest factor, 10% at the end of 3 years. So it will be 17.28, 10% for 3 years. Use the first table. 10% for 3 years. 10% for 3 years. Using the first table, you'll get an amount of 0.7530. And what do you get? So you'll have an amount of 12.982. That's the present value of cash inflow. To get NPV, you deduct the present value of cash outflow. Also project N, the capital was 10 million, you deduct 10, and our NPV will be 2.982. Now, remember the two projects were mutually exclusive, you just need to select one. Now, between project M and project N, which one has the highest NPV? Which one has the highest NPV? The one with the highest NPV will be project N. So you should undertake project N since it has a higher NPV. Good. So let's do another illustration. May 2014, question 1, not question 2, question 1. May 2014, question 1. Now, part of the question was, explain 4 features of an ideal investment appraisal method. 4 features of an ideal investment appraisal method. Now, those investment appraisal method, they are what we are doing here. NPV, discounted payback period, profitability index, IRR. And you see that some of those characteristics that, number 1, it should be a discounting technique. That means should take into consideration the time value of money. Number 2, should use cash flows as opposed to the use of profit. Then should use all cash flows. Then should give a clear decision on whether to accept or reject the project. And then it should help in ranking of the projects. Good. Number B of the question, number B. Kiwanda Limited is considering the launch of a new product M for which an investment of 6 million in plant and machinery will be required. So that's the investment, that's the capital, 6 million. The production of N is expected to last for 5 years, after which the plant and machinery will be sold for 1.5. So the machine will cost 6 million, but of which at the end of the economic life of 5 years, it will be sold for 1.5 million. So that's the scrapped value. So therefore, if you have to get depreciation, how do we get depreciation? The machine will cost 6 million, but the machine will not depreciate fully. It will have a salvage value of 1.5 million. So that means the depreciable amount is 4,500. And then the project will be usable for the next 5 years. So how much will be depreciation per annum? Depreciation per annum will be 900,000. Note that we only provide depreciation if you are given the tax rate, because we say that we are using the cash flow, not the profit. And depreciation is not an actual outflow. Depreciation is not an actual outflow. Depreciation is just a provision. So you only provide it for tax purposes. So if you're not given the tax rate, you ignore the depreciation. If you're given the tax rate, provide for depreciation. Additional information. M would be sold at 600 per unit with a variable cost of 240 per unit. Fixed production cost, excluding depreciation, would amount to 600 per annum. The company applies straight-line method of depreciation. Cost of capital 10% per annum. The number of units of product M expected to be produced and sold per annum for the next 5 years is shown below. So you have year 1 to year 5 and the expected number of units to be sold. The corporate tax rate is 30%. Required. Advise the management of Kiwanda Limited on the appropriate course of action using number 1, net present value. So we have to use the net present value. So how do we evaluate using NPV? We have said that NPV is the present value of cash inflow minus the present value of cash outflow. And in this case, the project is for 5 years. So you have year 1, year 2, year 3, year 4, year 5. So how do we get the inflows? To get the inflow, number 1, you are given the number of units you expect to produce, and then you are given the selling price. So therefore, you can be able to get the sales revenue. To get the sales revenue, you'll take the number of units, you multiply by the selling price. And the expected selling price we're given in note number 1, we expect to sell each unit at 600. Now, for example, in year 1, how much is the expected number of units we expect to sell? In year 1, we expect to produce and sell 8,000 units. So you'll take 8,000 each at 600 to get the revenue. So let our shillings be in thousands. So on that one, we get an amount of 4.8. Year 2, you do the same. Year 2, we are producing 7,000 each at 600, so it will be 4.2. Also, year 3 will be 4.2. Year 4, 3 million, here you'll have 1.8. Once you get the sales revenue, you raise the variable cost. You take the number of units. Note number 2, you are given the variable cost, expected variable cost per unit, which is 240. So you multiply by 240. So for example, the first one, you take 8,000 each at 240 and you get an amount of 1920. You'll get an amount of 1680. 1680. 1200. 720. Once you raise the variable cost, you're already given the fixed cost. Note number 3. And the fixed cost per annum is 600,000. That's per annum. So now with that, now we can be able to determine the earning before depreciation and tax. Earnings before depreciation and tax. So you take the revenue minus variable cost minus fixed cost. You'll have an amount of 2280, 1920, 1920, 1200. This one is an amount of 480. Then you can deduct depreciation. We had already computed the amount of depreciation, which is 900,000. That was depreciation per annum. And that's how now you get the earning before tax. The earning before tax, we have an amount of 1380. We have 1020, 1020. 300, here we have 420, which is negative. Then that's the earning before tax. Then you deduct tax, and we are told that tax rate is 30%. So you take the 30% of the earning before tax. So here it's an amount of 414. Here we have an amount of 306. 306. Here we have an amount of 90. In case we have a negative, you don't tax a loss. So therefore the tax will be 0. We don't tax loss. And that's how you get now the earnings after tax. So earnings after tax, we have 966, 714, 714. We have 210. This one remains to be 420, which is a negative. Now, once you get the earnings after tax, you add back depreciation. We see that you deduct the depreciation for tax purposes, but depreciation is not an actual outflow. So you add back depreciation. And depreciation was an amount of 900. And that's how now you get the cash flows. So this one will be 1866, 1614, 1614, 1110, this one will be 480. Then you also add, remember you told that machine will cost 6 million, of which at the end of the year, at the end of the economic life, it will have a salvage value of 1.5. So you expect to realize this 1.5 at the end of the economic life. So you add the salvage or the scrap value, of which will be realized at the end of the economic period, an amount of 1,500. So therefore adjusted cash flows will be an amount of still 1866, 1614, 1614, 1110, then here we have an amount of 1980. Now once we have the adjusted cash flows, our objective is to determine the present value of cash inflow, you rediscount. Present value interest factor, this one is not an annuity because the cash flow are not the same, so therefore you use the first table. And the cost of capital we already given was an amount of 10%, so it's 10% year N. So year one, 10% using the first table, 10% year one we have it 0.1991, 8264, 7513, 6830, 6209. Now with that, now we can be able to determine the present value of cash flows. You take the cash flows, you multiply by the discounting factor. So here we have an amount of 1696, 1334, 1213, 758, 1229. So therefore the total present value, now that's what we call the present value of cash inflow. You add the total for the 5 years. That's how we get the present value of cash inflow, and the total will be an amount of 6230. To get NPV, you take present value of cash inflow, you deduct the present value of cash outflow. How much had we invested at year 0 or at the beginning of the economic life? The machine was costing 6 million. And we have a net present value, an amount of 230. And that means since NPV is positive, therefore we can accept the project. If NPV is positive, we say that we accept the project. In this case, NPV is positive, that means the project is viable. So that NPV is positive, therefore we should accept. Still on NPV, now we want us to look at the presence of working capital, or the changes in working capital. Changes in working capital. And what are working capital? Now working capital is current asset minus current liability. It's current asset minus current liability. Now when evaluating a project, now working capital, it's an outflow at the beginning and becomes an inflow at the end. Let me repeat again. You are saying that for working capital is an outflow at the beginning and then becomes an inflow at the end. So an item of working capital, for example, if you buy raw material or you buy inventory worth 300. If you buy them now, so currently at the beginning it is an outflow because we're incurring. Then at the end, maybe after 2 months, after 3 months, you sell this stock. Now once you sell this stock in the future, you are receiving the cash. So that's why I'm saying that at the beginning it's an outflow, at the end becomes an inflow. As simple as that. And the working capital is the difference between the current assets and the current liability. So I want us to do that illustration in our notes. June 2008, question 3B. So the question is already in your notes. So let's do that question. And you're told that Baraka Limited is considering investing in a new processing machine costing 25 million. So the machine will cost 25 million. That's what we call the present value of cash outflow. The machine would be used for 5 years and thereafter be disposed for 5 million at the end of 5th year. So in this case, we are given the disposable value, or what we call the salvage value or the scrapped value. Additional information. Additional raw material amounting to 5 million will be required at the beginning of the 5-year period. That's the working capital. This would increase the account payable by 2 million. These changes in working capital would reverse at the end of year 5, would be reverted at the end of year 5. Therefore, how much is the working capital requirement? Working capital, we have said that's current assets minus current liability. And we are told that number 1, additional raw material amounting to 5 million would be required. Raw material is part of the stock, current asset. We require raw material worth 5 million at the beginning of the 5-year. This would increase the account payable. Account payable is part of the current liability, and it will increase by 2, so you raise 2. That means the working capital requirement will be 3 million. So that 3 million becomes an outflow at the beginning, then becomes an inflow at the end. The new machine would increase the company annual gross profit from 12 million to 24 million. Then the incremental fixed cost would amount to 2.2 million per annum. Number 4, additional machine operator would be employed at a cost of 1.6 per annum. The new machine would be depreciated on a straightened basis. So how much will be depreciation? This machine, we are told that it will cost 25 million, but it will not depreciate fully. It will be having a disposable of the scrap value at the end of year 5 of 5. So that means the depreciable amount will be 20 million. Then you divide by the economic life. The machine will be used for 5 years. So, and that means the depreciation per annum will be an amount of 4. Be an amount of 4. Good. Number 6, the cost of capital is 12%. Number 7, the corporation tax rate is 30%. Required. Using NPV, advise the company on whether to invest in the new machine using NPV. So you say that to get NPV is the present value of cash inflow, you raise present value of cash outflow. So how do we get the present value of cash outflow? For the outflow, we have the cost of machine, of which the machine will cost 25 million. Then we have said that working capital is an outflow at the beginning. Also, we have the working capital requirement. The working capital requirement is 3 million. So that means at the beginning, we need an amount of 28. That's our present value of cash outflow. How do we get the present value of cash inflow? To get the present value of cash inflow, let's come up with the cash flow statement. Cash flow statement. Now let's go to note number 2. The new machine would increase the company annual gross profit from 12 to 24. Incremental gross profit. Incremental gross profit will increase from 12 to 24. So it's 24 minus 12. Therefore, the incremental gross profit will be 12 million. Then we are told that number 3, incremental fixed cost would amount to 2.2 million per annum. We also deduct the fixed cost. The fixed cost will increase by 2.2 million per annum. Number 3, additional machine operator would be employed at a cost of 1.6 million per annum. Operator cost, machine operator cost per annum will be paying an amount of 1.6, and that's how now we get the earnings before depreciation and tax. And how much is that? You'll get an amount of 8.2. Then you raise depreciation. A depreciation was an amount of 4. Therefore, the earning before tax will be 4.2. Then we tax. The tax rate we are given is 30%. So we take 30% of 4.2. You get an amount of 1.26. Then you get earnings after tax. So 4.2 minus the answer, you get 2.94. Now, once you get the earnings after tax, you add back depreciation, an amount of 4. And therefore, our annual cash flows will be an amount of 6.94. 6.94. 6.94. Or alternatively, now listen here, this is the easiest method, the easiest way. If you take the incremental gross profit 12, you raise the fixed cost, you raise the operator cost of 1.6, you are getting 8.2. You see this 8.2 is earning before depreciation and tax. You can write it as earning before tax. Instead of earning before depreciation and tax, you write it as earning before tax. Then you tax at 30%. 30% of 8.2 to be an amount of 2.46. Then you get earnings after tax. Earning before tax, you raise tax to get the earning after tax, 5.74. Now, once you get the earnings after tax, you add what we call depreciation tax shield benefits. Depreciation tax shield benefit. You just take 30% of the depreciation. Depreciation per annum was 4, of which you get 1.2. And that's how you get your cash flows, of which you get an amount of 6.94. This amount and this one is the same. So instead of raising depreciation and then adding it back, you can just do it as one way like that. Earning before tax, you tax, you get earning after tax, and then you add depreciation tax shield benefits. Good, so this is our cash flow. Now once we get our annual cash flows, now we can discount present value interest factor of an annuity. Remember, these are the incremental cost per annum. So it's an annuity for the next 5 years. So it's the present value interest factor of an annuity. Cost of capital is 12%. The project is for 5 years. So we use the annuity table or the second table. 12% for 5 years. And with that, now we get the present value of annuity. And the present value of an annuity will be an amount of 25.017. That's the present value of an annuity. Then we have something we call the terminal benefits. Now for terminal benefit, number one, we had the salvage value. Remember, the machine will not depreciate fully. We are told that the machine cost will cost 25, of which at the end of year 5, the machine will be disposed at 5 million. So at the end of year 5, we expect 5 million. And also we have the working capital. Working capital was an amount of 3 million. We say that working capital is an outflow at the beginning, then becomes an inflow at the end. So at the end, we expect a total benefit of 8. Then we discount present value interest factor. This one is not an annuity, since will only be realized at the end of the 5th year. The cost of capital is 12% year 5. So use the first table. Using the first table, 12% after 5 years. How much will be that? Get an amount of 0.5674. So 8 times that, you get an amount of 4.54. So therefore, let's get the present value of cash inflow. We have the present value of an annuity, which is 25.017. Then you add the present value of the terminal benefits, which is 4.54. So therefore, the present value of cash inflow will be an amount of 29.557. Then to get NPV, you raise present value of cash outflow. Here it is. The present value of cash outflow is an amount of 28, and therefore the net present value will be 1.557. 1.557. Yeah, and since it's positive, therefore we can accept the project. Can accept the project. So in your notes, I have provided the advantages and disadvantages of NPV. Yeah, and one advantage of NPV is that it takes into account time value of money. So in short, it's a discounting technique. Another advantage is that it gives a clear decision on whether to accept or reject the project. When it's positive, you accept the project. When it's negative, you reject the project. Another advantage of NPV is that NPV is using cash flow as opposed to accounting profit. Yeah, and then another advantage is that it uses all the cash flows, and then it also consistent with shareholders' wealth maximization. You see, NPV, you see that this is the same as profit. we are determining, is it project giving us some profit? And the objective of the organization is for to maximize the shareholders' wealth or to maximize on the profit. Then we have some of the disadvantages. What are some of the disadvantages of using NPV? Now, cash flow used to determine NPV are usually estimates. You see, we are projecting this project for the next 5 years, so they are just estimates. We are not sure about the amount we are just using the estimates. So that's one of the disadvantage. Then number two is that it assumes that the cost of capital will remain constant throughout. For 5 years, if it's 10%, it assumes that it will not change. But sometimes it keeps on changing. So that's another disadvantage. It assumes that the cost of capital will remain constant over a given period, over the analysis period. Yeah, and also, in some time it gives a conflicting result with IRR. We'll come to discuss that one later. So I want to end that class at that junction. But remember, we are not through with the discounting technique. So in our next class, we shall discuss the other remaining two methods. We have discussed number one, discounted payback period, modified internal rate of return, and then we have discussed NPV. Then the other method we have is the profitability index, and then we have internal rate of return. So that one is what we'll follow in our next session. So thank you for your time.